I buy gold not because I hope it's going to go up, but rather because I'm afraid it's going to go up a lot. My standard of living to change. I don't want the gold price to go to $8,000. I don't want the whole set of circumstances that would cause that to occur.
Right.
I'm afraid it's going to. I sort of believe that we haven't had a real economic slowdown for a long time, and perhaps as a delayed consequence of an increase in at least nominal interest rates, it wouldn't surprise me to see an economic slowdown. An economic slowdown, we're going to have a very strong market for commodities.
Renowned investor RickRule of Rule Investment Media has a unique perspective on gold investment. He notes that their interest in gold isn't solely driven by hopes of its value increasing, but rather stems from a fear that it might surge significantly, impacting their standard of living. The recent spike in gold prices, reaching an all-time high of $2,100 per ounce during the Israel-Hamas conflict, is attributed to its appeal as a safe haven asset. Joni Teves, the precious metals strategist at an investment bank, anticipates further increases, projecting gold to hit $2,200 per ounce by year-end, driven by Fed easing and a weaker dollar. However, RickRule expresses caution about the demand side of the economy. Despite a lack of recent economic slowdowns, he foresees the potential for one due to increased nominal interest rates. This perspective aligns with his history of predicting economic recessions. The economic forecast 2024 has seen shifts, with lawmakers and the U.S. Federal Reserve anticipating a soft landing. While the prevailing belief is that the slowdown will be mild, renowned author Robert Kiyosaki warns of an imminent, vast economic downturn. This divergence of opinions adds a layer of uncertainty to the economic outlook. RickRule also comments on the bond market's resilience despite higher interest rates. In January 2024, short-term bonds yielded more than longer-term ones, a trend consistent with the past 2 years. Despite the surprise, Rule hesitates to invest in U.S. Treasury bonds with a 4% return when real inflation might be 7%. He underscores the risk of holding assets with a negative 3% yield against $146 trillion in liabilities. Join us as we delve into insights shared by RickRule. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The idea that the bond market didn't get waxed worse with a doubling of nominal rates astonishes me. I'm delighted to be astonished, believe me. I'm really happy to be astonished. Would I buy a U.S. 10-year Treasury? No way. I'm a credit guy. They're paying me 4% in a currency where the notional CPI rate is 2.8, where I think the real deterioration of the purchasing power of my US dollars is more like 7% compounded. The idea that I would take a negative 3% yield in favor of a creditor that has $146 trillion of liabilities, I mean, come on.
Who wants a declining asset for bad Chris?
There's still the risk of default as well.
This is like arithmetic. Cautious on the demand side for the economy. I need to say, I've predicted 17 of the last 3 recessions. So being a credit guy, I'm always concerned. But I sort of believe that we haven't had a real economic slowdown for a long time. And perhaps as a delayed consequence of an increase in at least nominal interest rates, it wouldn't surprise me to see an economic slowdown. An economic slowdown, we're going to have a very strong market for commodities simply because of global population growth, an increase in living standards among the poorest third of humanity, and the fact that society has underinvested in extractive industries for 30 years. Meaning, I think that commodity supplies are going to be tight 5 to 7 years out, irrespective of whether we have a recession. If we do have a recession, the impact of that will be muted because you can have declining supplies if you have declining demand, and prices don't move. I realize that's a convoluted answer, but it's the best answer that I can give. I have zero doubt that we're going to have supply shortages in conventional energy, in oil and gas. Not because of demographics, but rather because of an underinvestment in sustaining capital by the industry, including state-owned industries, of $1 billion a day. I think that we're going to have supply shortages in base metals simply, again, because we haven't been investing in productive capacity, and the permitting timelines are extraordinary. Whether or not prices go higher or lower and share prices respond well really depends on the strength of the general economy. Concerns me more, perhaps because I'm 70, is the off-balance sheet liabilities. If you add back the net present value of promises society has made to each other, Medicare, Medicaid, military pensions, Social Security, according to the congressional budget, not some cranky, fat old libertarian, the net present value, not nominal value, but net present value of those obligations is $120 trillion. And you try and service that debt with a demographic that gets older every year and a budget that's $2 trillion in deficit. Sometimes I'm happy that I'm not an economist. As a credit guy, I would say to a borrower that was $140 trillion in debt and was enjoying negative free cash flow of $2 trillion a year, is start saving. And it's very difficult for me. I mean, I understand how you dig your way out of this. People your age, Kai, say to people my age, you guys voted yourself all this cool stuff and you forgot to pay for it. So you pay for it, because we're not gonna.
Okay.
Politically, it's probably not palatable to end Social Security, Medicaid, Medicare, military pensions, and the Environmental Trust Fund. But X that, it's very difficult for me to understand how we dig our way out of this. I'm concerned that my countrymen aren't good enough at arithmetic, or whatever their shortcoming is, that they don't understand the drag of the net present value of entitlements on the economy that my generation leaves to your generation. And it ain't pretty. People talk about the wealth effect, how the baby boomers are allegedly going to leave $120 trillion, or $140 trillion, pardon me, in inherited wealth to the next generation. They're also leaving them $146 trillion in debt, meaning that the net transfer of wealth is negative. Now, it goes to different people. You know, there's a whole bunch of rich old guys like me that are going to leave lots. And then there's everybody else who are going to get left a donut. And those who get the donut are not going to be happy.
In junior markets, 2024 holds promising prospects, driven by favorable pricing dynamics and a receptive audience. Rick, a seasoned observer who refrained from active participation for 12 years due to perceived high risks, now perceives a more favorable risk-to-reward ratio. Gold stocks experienced an atypical performance in 2023, marked by subdued prices and anomalies. A shift is expected in 2024 as markets normalize, with gold miners poised for a mean reversion rally. Despite a mid-year decoupling from gold, the sector is regaining ground, with the gold miners ETF rallying 18.8% from its October low. Though lighter than gold's rebound, the trend is improving, reflecting a new Federal Reserve dovish paradigm. Experts anticipate momentum in gold and gold stock upswings in 2024, driven by various factors. However, amidst the optimism, Rick expresses a note of caution regarding a potential liquidity crisis. Given the anticipated high volatility in the market, he is particularly wary of a black swan event. The concerns about unforeseen disruptions are echoed by financier and business magnate Gary Cardone, who predicts a black swan event in 2024, with the potential to impact the U.S. general election. Let's get back to the interview.
I think in the junior market, this is going to be a very good year. You have, for the first time in 12 years, you have really good pricing. You have an audience that's ready to take advantage of really good pricing.
I've been hearing your name thrown around a few private placements the last 2 weeks as well. So.
Yeah, I mean, I've been priced out of the market for 12 years. For me, if I looked at the juxtaposition of risk to reward between the space that I used to inhabit, which is the juniors, and the more senior companies exhibited much, much, much better ratios of risk to reward. We were in such a speculative environment, such a narrative-driven environment, that dumb money chased out smart money. The dumb money has gone to money heaven, which is where it rightfully belongs. And so now there's room in the space for some smart money to come back. I think that's useful. I would argue that the extractive industry has been over rather than underfunded for most of my career. I would argue that the bane of the gold industry has been that its cost of capital, its real cost of capital, has been sub-zero. If you define the cost of capital as being relevant to the premium to net asset value that equity capital has been raised at. Traditionally, the gold mining sector has been priced at about twice NAV, which means that anybody who is able to raise any money at 2 times what their company is worth has a negative cost of capital. So I would suggest that the bane that the industry faces is not the presence of high cost of capital, but rather a history of low cost of capital. And I think that has incented truly insanely stupid investment allocation decisions, which is why the industry is held in such disfavor. I think there's a possibility of a liquidity crisis. I think there's a possibility, given how much volatility we'll face, that there is a black swan out there that causes a liquidity crisis. The thing that makes me most nervous about, by definition, you don't see a black swan, right? But the thing that makes me most nervous is junk corporate debt. The holdings of several $1 trillion in junk corporate debt in ETFs, where the superstructure is very liquid and the underlying assets are illiquid. If you had a circumstance where there was concern among the population in credit quality, the junk bonds started to sell off, people started redeeming ETFs, the manager won't be able to sell the underlying security. And that would be truly, truly, truly ugly. I'm not sure I think that that's a probability, but it's a strong enough possibility that I'm chased all the way out of the high yield market, even for credits that I know and like.
Well,
Can you imagine a nation that created 24% of the world's savings and investment assets, the United States, having a choice between Biden and Trump?
yeah, right. That's true.
I mean, that's... it's difficult for me to understand how anybody could be for either of them. I could understand voting against either of them. That would be easy. But the idea that a country that's vibrant enough that they still, after all the years that they've tried to wreck it, comprises 24% of the world's savings and investment assets, having a choice between Biden and Trump is incomprehensible to me.
As 2024 unfolds, the economic predictions paint a landscape of uncertainty, with experts divided on the trajectory of the U.S. economy. Some foresee moderate slowdowns and manageable downturns, fostering a sense of cautious optimism. However, a notable dissenting voice, such as RickRule and Gary Cardone, warns of dramatic and unforeseen events that could potentially reshape the political and economic fabric of the United States. How do you perceive the role of gold as a safe haven asset amid economic uncertainties in 2024? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.